5 financial beliefs that keep you broke forever. If I could listen to your internal dialogue about money for 24 hours, I could predict your financial future. Not because I can see the economy, not because I know your salary, but because wealth is not built by effort alone. It is built by the stories you repeat without noticing. Pay attention to what you say when you look at your bank account. Listen to how you justify your spending. Notice the tone you use when someone mentions investing, negotiating, building something bigger. Those reactions are not random, they are architecture. Most people think they have money problems. They don't. They have identity problems. Money expands who you already are. It does not fix who you are not. If you are undisciplined, more money magnifies chaos. If you are fearful, more money magnifies anxiety. If you lack structure, more income only increases pressure. What you call financial frustration is often a misalignment between your identity and the level of wealth you claim to want. And here is where it becomes uncomfortable. You are not held back by a lack of information. You are held back by invisible contracts you signed without reading. Contracts that sound responsible. Contracts that feel mature. Contracts that were handed to you by family, culture, and experience. Today we are exposing 5 of them, not surface-level beliefs, clichés, but the mental agreements that quietly determine whether you build wealth or repeat the same financial year over and over again. 1. I must feel secure before I take financial action. This belief sounds intelligent. It sounds cautious. It sounds responsible. It sounds like something a mature adult would say when trying to avoid mistakes. I will invest when I feel safer. I will start the business when I have more saved. I will negotiate when I am more confident. I will change careers when the market feels stable. I will take action when the timing feels right. On the surface, this belief feels like wisdom. It feels strategic. It feels like patience. But underneath that calm exterior, there is a silent pattern that keeps you financially stuck for years. The hidden assumption is that security must come first and action must come second. But in the real world of wealth building, security is rarely the starting point. It is almost always the result. Financial security is constructed through movement, through exposure, through calculated risk, through decisions that stretch your current comfort zone. When you wait to feel secure before acting, you create a paradox. You refuse to move because you do not feel safe. Yet you do not feel safe because nothing in your financial reality is expanding. This creates an invisible cycle. You prepare. You analyze. You wait. You research. You watch others take action. You tell yourself you are being careful. But careful slowly becomes passive. Passive slowly becomes stagnant. And stagnant quietly becomes your identity. There is something deeper driving this belief. It is not strategy. It is protection. Your brain is designed to avoid uncertainty. Financial action introduces uncertainty. Investing means you could lose money. Negotiating means you could hear no. Starting something new means you could fail publicly. Your nervous system interprets these possibilities as threats, so it convinces you to delay. It tells you that more preparation will eliminate risk. It tells you that someday you will feel completely ready. But readiness is not a feeling that arrives fully formed. It is a muscle that develops under pressure. Every financially strong person you admire has made decisions without total certainty. They did not eliminate fear before moving. They accepted fear as part of the process. They did not wait for confidence to magically appear. They built confidence by taking repeated action despite discomfort. They did not demand guaranteed outcomes. They improved probabilities by increasing skill, knowledge, and strategic thinking. If you study your own financial hesitation honestly, you will notice a pattern. You do not delay small purchases. You do not delay comfortable expenses. You delay moves that could expand your capacity. You delay investments in yourself. You delay calculated risks that could change your trajectory, and you label this delay as responsibility. But there is a difference between caution and avoidance. Caution evaluates risk and moves forward intelligently. Avoidance searches for reasons to stay still. The cost of this belief compounds over time. While you are waiting to feel secure, inflation reduces purchasing power, opportunities close, industries evolve. Your energy shifts. Your responsibilities increase. Time does not pause while you gather courage. It continues moving, and those who act accumulate advantages that multiply quietly. True financial security is not the absence of risk. It is the presence of adaptability. It is built through diversified income streams, strong skills, disciplined savings, strategic investments, and resilient thinking. None of those are developed by waiting. They are developed by engaging with uncertainty and learning to navigate it. When you demand emotional certainty before financial action, you are asking life for a guarantee it never promised. Growth requires temporary instability. Expansion requires tension. Progress requires the willingness to step into situations where the outcome is not fully controlled. If you continue believing that you must feel secure before you act, you will spend your life preparing for a version of the future that never arrives. You will collect information but avoid execution. You will watch others build while you remain in rehearsal mode. And one day you may realize that the safety you were protecting was actually the cage that kept you small. Security is not something you wait to feel. It is something you build through disciplined action on the other side of discomfort. Too money is about how much I make, not who I am. This belief hides behind numbers, spreadsheets, salaries, and comparisons. It sounds rational. It sounds objective. It sounds mathematical. If I earned more, everything would change. If my salary doubled, I would finally save. If I had a higher income, I would invest. If I made what they make, my life would look different. On the surface, this belief feels logical. After all, money is numeric. Wealth seems measurable. Income appears to be the variable that controls everything. But this belief quietly blinds you to the real driver of financial outcomes. Income does not create wealth. Identity creates wealth. There are individuals who earn modest incomes and build stable, growing portfolios over time. There are others who earn extraordinary salaries and remain trapped in debt, stress, and lifestyle inflation. The difference is not arithmetic. The difference is behavioral architecture. It is standards. It is discipline. It is long-term orientation. It is the internal identity that governs external decisions. When you believe that more income will automatically solve your financial problems, you avoid confronting the patterns that are already shaping your results. You tell yourself the issue is external. You place responsibility on the market, your boss, your industry, the economy. You assume that once the number increases, the pressure disappears. But what actually happens in most cases is this: when income rises without identity, growth, expenses rise to match it. If you see yourself as someone who struggles with money, that identity will express itself regardless of your salary. You will justify impulsive purchases because you deserve them. You will normalize higher monthly obligations because you can now afford them. You will postpone investing because you finally feel comfortable. And comfort without structure becomes complacency. Money amplifies who you already are. If you are disciplined at a low income level, that discipline scales. If you are reactive, emotional, and unstructured at a low income level, those traits scale as well. A larger paycheck simply increases the size of your decisions. it does not automatically improve their quality. There is also a psychological trap inside this belief. It keeps your focus on earning instead of becoming. Earning is important, but becoming is transformative. When your entire strategy revolves around making more, you neglect the internal upgrades that sustain wealth. Financial literacy, emotional control, delayed gratification, negotiation skills, asset allocation, strategic thinking. These are identity traits, not income brackets. If you cannot manage 1,000 responsibly, you will not magically manage 10,000 responsibly. The habits that govern small amounts govern large amounts. The patterns repeat at a higher scale. The anxiety follows you. The impulsivity follows you. The lack of planning follows you. Without identity expansion, income growth only increases complexity. Another danger of this belief is comparison. You measure your worth against other people's visible numbers. You assume that the person driving a certain car or living in a certain area has solved the puzzle. But visibility is not the same as stability. Many high earners are financially fragile. They depend entirely on active income. They have no margin, no resilience, no real leverage. They look wealthy, but lack financial freedom. True wealth is not defined by how much you make in a month. It is defined by how long you can sustain your life without depending on constant labor. It is defined by assets, systems, and decisions that generate value beyond your time. That requires identity transformation. It requires seeing yourself not only as an earner, but as an allocator. Not only as a consumer, but as a builder. When you shift from "I need to make more" to "I need to become more disciplined," strategic, and intentional, everything changes. Income becomes a tool, not the solution. Raises become opportunities for leverage, not excuses for lifestyle expansion. Growth becomes structural, not temporary. As long as you believe money is only about how much you make, you will chase higher numbers without addressing the person handling them. And if the person does not evolve, the numbers will not save you. They will simply magnify your existing patterns. Wealth is not built by income alone. It is built by identity. And until that identity shifts, your financial ceiling will remain exactly where it has always been. 3. Debt is normal, and I'll deal with it later. This belief does not feel dangerous. It feels ordinary. It feels socially accepted. Almost everyone carries some form of debt, so it must be normal. Credit cards are common. Financing is common. Monthly payments are common. The phrase "I'll deal with it later" becomes a quiet promise you make to yourself over and over again. Later when I earn more. Later when things stabilize. Later when I get serious. But later rarely arrives the way you imagine. Debt is not just a financial condition. It is a psychological pattern. It trains you to prioritize the present version of yourself over the future version of yourself. Every time you choose immediate comfort funded by future obligation, you reinforce a habit. You teach yourself that relief now is more important than freedom later. Over time, that habit becomes identity. The most dangerous part is how subtle it is. A small purchase here, a financed upgrade there, a balance carried just this month. None of it feels catastrophic in isolation. But debt compounds silently. Interest does not sleep. It does not forget. It does not negotiate with your excuses. While you are postponing responsibility, the numbers are reorganizing your future without your permission. There is also an emotional layer to this belief. Debt allows you to maintain an image. You can look stable while being fragile. You can look successful while being dependent on credit. You can maintain a lifestyle that your current income cannot truly sustain. And because everything still functions on the surface, you delay the discomfort of correction. But debt creates pressure. Pressure reduces flexibility. Flexibility is power. When your income is already assigned to past decisions, your ability to pivot shrinks. You cannot take opportunities easily. You cannot invest aggressively. You cannot walk away from unhealthy environments. Your financial past dictates your present options. Saying I will deal with it later is often code for I do not want to confront my habits. Because confronting debt is not only about numbers. It is about behavior. It forces you to examine spending patterns, emotional triggers, and the gap between your income and your standards. It requires restraint. It requires saying no. It requires accepting temporary discomfort to reclaim long-term control. Another hidden cost of normalized debt is mental bandwidth. Even if you try to ignore it, it occupies space in your mind. It creates background stress. It influences decisions. It makes you more risk-averse in some areas and more reckless in others. It keeps you in reaction mode instead of creation mode. Wealth building demands margin. Margin is created when your income exceeds your obligations by a meaningful gap. Debt shrinks that gap. When most of what you earn is already committed, you are not building. You are maintaining. You are running in place. Breaking this belief requires a shift in identity. Instead of seeing debt as a tool for lifestyle maintenance, you begin to see it as a constraint on future freedom. Instead of asking, can I afford the monthly payment? You ask, what is this decision costing my future flexibility? Instead of delaying responsibility, you prioritize elimination. The people who escape financial mediocrity treat debt with urgency, not casual tolerance. They understand that every dollar sent to interest is a dollar not building assets. Every month spent postponing action extends the timeline of freedom. If you continue believing that debt is normal and can be handled later, you will normalize financial pressure. You will adapt to constraint. You will design your life around payments instead of possibilities. And over Chimi that neither Leroy's. Financial freedom begins the moment you stop negotiating with obligations that shrink your future. Later is expensive. The longer you wait, the more it costs. For investing is risky, so it's better to stay safe. This belief sounds prudent. It sounds conservative. It sounds like wisdom passed down from someone who has seen losses and wants to protect you from pain. Investing is risky. Markets crash. Businesses fail. People lose money. Better to stay safe. Better to keep cash where you can see it. Better to avoid what you do not fully control. On the surface, this feels like protection. It feels like intelligence. But beneath it lies one of the most expensive misunderstandings in personal finance. There is no such thing as staying financially neutral. When you choose not to invest, you are not avoiding risk. You are choosing a different type of risk. The risk of stagnation, the risk of erosion, the risk of watching your purchasing power decline slowly over time. Safety, in this context, is often an illusion created by stillness. Money that sits without strategy does not remain equal. Economies expand. Prices rise. Opportunities evolve. When your capital does not participate in growth, it quietly loses relative strength. The danger is subtle because it is gradual. There is no dramatic moment, no visible crash in your account. Just a slow decline in what your money can actually do for you in the future. This belief is usually rooted in fear of volatility. Seeing numbers fluctuate creates emotional discomfort. A temporary drop feels like permanent loss. But volatility and loss are not the same thing. Volatility is movement. Loss becomes real only when decisions are made from panic or ignorance. The problem is not investing itself. The problem is investing without understanding. When you label all investing as risky, you close the door on education. You avoid learning how assets work. You avoid understanding diversification. You avoid studying long-term trends. You remain dependent on active income because it feels familiar. And familiarity becomes your definition of safety. But relying exclusively on active income is its own risk. Jobs change, industries shift, companies restructure, health fluctuates. If your entire financial life depends on your continuous labor, your stability is fragile. Investing, when approached intelligently, is a way of building systems that work even when you are not actively trading hours for money. Another layer of this belief is control. Keeping money in a savings account feels controllable. You see the number. It does not move dramatically. It appears stable. But control over appearance is not the same as control over outcome. True, control comes from understanding how different vehicles behave over time and positioning yourself strategically. Wealth is built through participation in growth. Businesses grow. Real assets appreciate. Markets expand over decades. Innovation creates new value. When you refuse to participate because of fear, you remove yourself from the mechanisms that generate long-term wealth. The people who build financial freedom do not eliminate risk. They manage it they spy. They think in decades instead of weeks. They expect temporary fluctuations and do not interpret them as personal failure. They understand that short-term discomfort is often the price of long-term expansion. If you continue believing that investing is too risky and that staying still is safer, you may preserve your comfort today at the expense of your capacity tomorrow. You will work longer than necessary. You will depend more heavily on earned income. You will watch others compound advantages while you protect a number that is quietly shrinking in real terms. Real safety is not found in avoiding movement. It is found in strategic participation. It is found in informed decisions. It is found in building assets that grow beyond your effort. Avoiding risk entirely does not create security. It creates limitation. The question is not whether investing carries risk. Dois. The question is whether you are willing to remain exposed to the even greater risk of never allowing your money to work for you. 5 rich people are different from me. This belief is rarely spoken out loud, but it quietly shapes financial ceilings. You see someone wealthy, and instead of thinking that is possible, you think that is different. They were born into it. They had connections. They are more talented. They are naturally good with numbers. They think in ways I never will. Without realizing it, you create psychological distance between yourself and wealth, and what feels distant rarely becomes attainable. When you believe rich people are fundamentally different from you, you protect your current identity. You avoid the discomfort of transformation. Because if they are different species, then you do not need to change. You do not need to raise standards. You do not need to adopt new habits. You do not need to question your excuses. Their success becomes something external instead of something instructive. This belief is dangerous because it disguises itself as realism. You tell yourself you are being honest. You tell yourself you are just acknowledging your circumstances. But what you are actually doing is reinforcing limitation. You are training your brain to filter out evidence that contradicts your narrative. Every wealthy person who built from nothing becomes an exception instead of a model. Every story of discipline and persistence becomes luck in your interpretation. Identity always seeks consistency. If you see yourself as average, your behavior will protect that identity. If you see wealth as something for other people, you will subconsciously reject opportunities that challenge that story. You will underprice yourself. You will avoid high-level rooms. You will stay silent in negotiations. You will shrink your ambitions to match your internal self-image. Wealth is not a personality type. It is a set of behaviors repeated over time. Strategic thinking, long-term planning, emotional control, delayed gratification. continuous learning. These are not traits assigned at birth. They are cultivated. They are chosen. They are reinforced daily. When you study financially successful individuals closely, you will find patterns rather than magic. They think in assets, not only income. They measure decisions in years, not days. They tolerate short-term discomfort for long-term positioning. They build networks intentionally. They allocate capital with purpose. None of this requires a different species. It requires a different standard. The belief that rich people are different also protects you from responsibility. If their success is due to something you do not possess, then your stagnation is justified. You can blame environment. You can blame background. You can blame timing. Responsibility feels heavier than comparison, so comparison becomes your refuge. But the moment you collapse the distance, everything changes. The moment you see wealth as a result of patterns rather than privilege alone, you regain agency. You begin asking different questions. What skills do I need to develop? What rooms do I need to enter? What habits must I eliminate? What risks am I avoiding? What knowledge am I ignoring? This shift is uncomfortable because it removes excuses. It places the mirror in front of you. It forces you to admit that some of your limitations are maintained by choice. Not because change is easy, but because remaining the same is familiar. As long as you believe rich people are different from you, you will protect your current identity at the cost of your future potential. You will admire from a distance instead of learning up close. You will justify instead of evolve. And your financial life will reflect the standards you silently accept. Wealth does not belong to a different type of human. It belongs to those willing to think differently, act differently, and persist differently. The question is not whether you are the same as them. The question is whether you are willing to become the version of yourself that operates at that level. If you look closely, none of these beliefs are loud. None of them announce themselves as self-sabotage. They sound reasonable. They sound cautious. They sound socially acceptable. Wait until you feel secure. Earn more first. Deal with debt later. Avoid investing because it is risky. Wealthy people are different. Each one feels harmless in isolation. But together, they create a psychological framework that guarantees financial stagnation. Your financial reality is not random. It is the visible expression of invisible agreements. Agreements about risk. Agreements about identity. Agreements about comfort. Agreements about what is possible for you. As long as those agreements remain unquestioned, your results will remain predictable. Most people try to change their bank account without changing their beliefs. They download budgeting apps. They watch investment videos. They set short-term goals. But if the underlying narrative stays the same, behavior eventually returns to its default pattern. You cannot build a different financial future with the same internal architecture. The shift begins with awareness. Notice when you delay action in the name of safety. Notice when you blame income instead of upgrading discipline. Notice when you normalize debt to protect your lifestyle. Notice when you label investing as dangerous without educating yourself. Notice when you place wealthy individuals in a separate category from yourself. These micro thoughts shape macro outcomes. Wealth is not built in dramatic moments. It is built in repeated decisions aligned with a higher standard. It is built when you act before you feel completely ready. When you manage what you have before demanding more. When you eliminate obligations that shrink your flexibility. When you allow your money to participate in growth. When you collapse the psychological distance between who you are and who you could become. The uncomfortable truth is that no external change can permanently override internal resistance. More income will not save poor habits. More information will not override fear. More opportunity will not help if you still see yourself as someone who cannot win financially. But the empowering truth is this: beliefs can be rewritten, identity can be expanded, standards can be raised, patterns can be interrupted. The same mind that adopted limiting agreements can adopt empowering ones. Your future wealth is not decided by luck alone. It is shaped daily by the story you repeat about money and about yourself. If you change the story, you change the strategy. If you change the strategy, you change the outcome. The question is not whether these 5 beliefs are common. They are. The question is whether you are willing to let them continue governing your financial life. Because the moment you refuse to accept them, you stop being someone who stays broke by default. And you begin becoming someone who builds wealth on purpose. If this content made you think differently, don't let that awareness fade here. Subscribe to the channel, turn on notifications, and leave a like so more people can be exposed to this mindset. Every week, I bring content designed to strengthen your mind, your discipline, and your vision about money and life. I will see you in the next video. Keep getting stronger